Welcome to Real Estate Conversations from Compass. I'm Mike Simonsen. I'm the chief economist for Compass, the largest real estate brokerage in the country by sales volume. My mission is to help everyone understand what's actually happening right now in the real estate market so they can make the best decisions when buying or selling a home. With Compass Intelligence, we publish the latest data every week. You can see that data and my video analysis on the Compass YouTube channel, and you can get on our Compass Intelligence mailing list. We put the data, video, and charts in your inbox every Monday. With the Real Estate Conversations podcast, I seek expertise and insights from the best leaders and thinkers in our industry. These conversations help me understand and hopefully help you understand the trends and dynamics driving the market today. So stick around for more real estate conversations. Today's conversation is with Logan Mohtashami. Logan is the lead analyst for HousingWire and is one of the most encyclopedic observers of the housing market that I know. A multi-decade veteran of the mortgage industry, he's been writing about real estate for many years. Logan and I will both be on stage at the HousingWire Housing Economics Summit on February 10 in Dallas. If you're interested in understanding the housing market right now, that's a really great event with the best minds and the best data in housing and mortgage. Check that out. It's been a while since Logan and I had a chance to catch up. So this conversation, we talk about the 2025 market and our forecast for the 26 market. There's been a ton of news and announcement and housing policy changes in just the last few days. So we also dive into those, which are important, which are futile. And we explore possible impacts on the year in housing. We cover a lot of ground. Logan is always entertaining, so stick around for Real Estate Conversations with Logan Mohtashami and me, Mike Simonsen. Logan Mohtashami, welcome to the show.
It is wonderful to be here, Mike.
It's great to see you. It's been a little while. We've both been running like mad, doing all kinds of housing market data stuff.
We've both been busy, yes.
Both been super busy. Lots to talk about today. It's the beginning of 26, and we now both published our outlooks for the year. We've got crazy dynamics in the mortgage markets. So let's maybe start with, let's do an overview of 2026. What are you thinking about? What are the trends? What are the numbers? What are the themes?
My main theme is I love 2026. I call it the chart daddy doctrine. It is an official tug of war now, right? There's enough inventory where buyers feel like they can do something, and there isn't too much inventory nationally to feel like sellers need to make too much of a change. And there's just this nice back and forth. And we're starting the year with lower rates, lower mortgage spreads. You know, there's a lot of rate cuts into the system. So because home price growth cooled down the last 2 years and wages rise and households are formed, it's the healthiest backdrop since the crash of 2022 in sales. So that's kind of that's why I love this backdrop going into the year, because we have more inventory, because price growth has cooled down, and we have a little bit better of a mortgage market now with less volatility going out for 2026.
Yeah, the healthiest backdrop. We've going in there. So you have we already had a dip to 6% in rates at the beginning of the year. A lot of us, I think, a lot of folks forecasted maybe 5.9 was a low rate for the year, staying in the sixes most of the year. What's your outlook for rates for the year, and what's the framework that gets you there?
So I'm a bond market guy. I actually never target mortgage rates. I target where I think the 10-year yield can range in, and then where the spreads are. So for me, it's kind of been the same. It's really hard for me to get mortgage rates below 5.75 with Fed policy being neutral, the labor market intact, and mortgage spreads not back to normal. One of those things are almost back to normal now, at least in the upper range of normal. So that's a positive check mark. And mortgage spreads have been getting better since the end of 2023. But it's just, I can't get that next level there as long as the Fed is in neutral policy and the labor market still intact. So that's kind of the low point. Of course, if jobless claims start to break or something like that, then you can go lower. If the Fed changes their language and their tune, that you could, but it's just I can't mathematically get the 10-year yield below 380 or mortgage rates below 5.75 unless there's things that's changing with the economy or the Federal Reserve.
Right. And so the 10-year is currently at 4.2. So, or roughly, and it hasn't really broken below 4 in a while.
No, it's acted very, very healthy last year. It's acting very normal even right now with Fed being a neutral policy. For the 10-year yield to go under 380, man, 2024 was one of those years where the bond market really thought we were going into recession. The growth rate of inflation was falling, so it just egregiously went underneath 380 for a very brief time. And then the economic data got better and rates just shot up. Now it's a little bit different, right? The labor market, 21st century lows in job creation in 2025. Wage growth is slowing down. We have more unemployed workers than job openings. There's things that the Federal Reserve really kind of focuses on that can keep rates a little bit more stable and lower, and the spreads are better this year. And it took a while to get there, but what's happening with mortgage spreads is typically what happens to them in every decade whenever you come off of a higher level. So the backdrop is healthier now than in the past, where you still had the ability for yields and rates to shoot up higher like they've done in multiple years recently. But now I think my high end forecast is like 6.5, 6.75, but that really requires the labor market to be better, right? If I'm a labor over inflation person, job growth has to pick up, wages have to pick up, and the unemployment rate has to fall down. That's my best case for rates to go up, at least to those levels. But to get below 5.75, it's hard for me to go there without certain things changing first.
Yeah. So let's talk about some of those certain things that might change. We've seen, the Trump administration is suddenly on fire for housing market. If Powell's term is up in May, do we get a scenario where suddenly the Fed rolls into accommodative and stimulative in May? And does that change things? Is that enough?
Not with the new Fed chairman. Let's hypothetically just say it's Kevin Hassett. Kevin Hassett will be a yes man. There's going to be no more hawkish statements after Fed meetings or anything, but he cannot unilaterally do it. They need more votes, right? So if somehow President Trump can, fire, remove, or whatever, a few Fed governors, then they can have the votes. But until they get the votes, I don't treat it any differently, but just a more dovish sounding Fed chairman, because he's not going to have the same language as Powell's going to have. That's not going to really move the needle too much, because there's so many Fed members there that are not for rate cuts or believe policies not restrictive enough. So the new Fed chairman can't do it himself, but there's just going to be a more dovish tone in everything he says going out until his term's over.
Yeah. So it's getting more dovish, but it's notable that just replacing Powell doesn't do it enough for the rates.
It doesn't. It's not gonna change the dynamics, but I mean, it's definitely you're never going to get a hawkish Fed statement or Fed meeting or Q&As, and there's going to be a lot of pressure on people that don't want rate cuts. So it's going to be a much different dynamic going out. There's going to be a lot of stuff in 2026 that are just different. We said part of the forecast was get ready for the X variables, because it's midterm, right? It's midterms. You got to throw everything at it to try to get the midterms to think. So they're gonna send every bazooka they have out to try to pump up the economy. And definitely housing has been a theme for them. Sarah and I, when we did our podcast when Trump won, we thought 3 things that the White House really needs. They need lower oil prices, they need lower mortgage rates, and they need a lower dollar to make this work if they're going into a trade war. So I think this year is just, we're going to get a lot of stuff coming out, and we'll see what sticks, what doesn't stick. But I call it the show 24 Jack Bauer. Every day there could be some headline 4 hours, and it's just like whatever. We just got to deal with it.
Yes. That great show. Okay, so that was does Powell is Powell enough to get us there on changing the Fed? But another one is the spreads. So in the last 6 months, the 10-year really hasn't gone down, but mortgage rates have eased down because of the spread between the 10 and the 30-year. One of the reasons, they had the big announcement about buying Fannie and Freddie buying mortgage-backed securities. Announced it last week when we were recording this, and then the spread dropped by 20 basis points like overnight. But they've been buying for 6 months. And so, do you have a view of is it all been driven by Fannie and Freddie buying since 6 months, or are there other factors that are driving spreads lower that are more important?
So before the year started, when I talk about spreads getting better in 2024, I don't think there was a lot of people that was in that camp. But if you look at the history of spreads, when the Federal Reserve is done hiking rates and the next move is lower and the spreads are elevated, the history of the spreads, when volatility compresses, they go lower. It doesn't matter who is buying or not buying, the history of it's going lower. What happened last year is I was looking for about a 27 to 41 basis points better spreads for the year using a 254 average in there. And we kind of hit that, and we got a little bit better than that toward the end. So Freddie and Fannie used to be big buyers of mortgage-backed securities back in the day. So that's part of it, but I just think the natural progression of how spreads act at this point of the cycle is the big driver, more than what Freddie and Fannie are doing. Now, that was a very, very wild Friday trading after the news, which was really funny because I was speaking in Utah, and they literally made me a peanut butter cup with it's, instead of saying Jif, peanut butter, they had mortgage spreads and it's going to be great and creamy and rich. And then the announcement came about the mortgage back, purchases. So the timing was fortuitous, but spreads would have gotten better, but they're almost back to normal. Like I don't have spreads going under 160 because I don't see it. But so we were at 2% before the year started, and we literally like 2 or 3 basis points away from being back to the normal range. And that's it. I think most of the spread story is over with. Okay. But I look at it as that announcement happened, and then like within hours they sent the DOJ's letter to Powell. So to me, I was like, wait a second, that timing is, that's not it. Now it makes sense. They want a little bit of more protection because they want mortgage rates go lower, all the marketing from the White House in the last 24, 40 hours. Lower mortgage rates, sub 6%, near 6% mortgage rates, everything. So the spread is, because so much of it is improved already, there's not really much downside left. That's also somewhat of a defensive mechanism for this year to make sure spreads never go up in a meaningful way as well, which it typically doesn't really do anyway. But you can see this was done tactically with the spreads and then Powell's announcement. And here we are. But they were 2% before the year started. I had them getting back to normal. I was looking for middle or the late part of the year, but we almost got there with that one. That was an abnormal trading day. Very wild move on that Friday.
Yeah. The the sum on that is that mortgage rates have been improving because the spread between the 10-year and the 30-year is increasing, and that really means that in the bond markets there's a shift towards people having a little more demand for mortgage-backed securities. It means they're feeling safer, less risk, and that there's a little bit of a less risk premium between the 10-year and the 30-year. But I think the interesting takeaway, and this makes sense to me, which is that most of those gains are gone. And so we're not going to keep, if the 10-year stays at 4 to 2, we're not going to get rates that fall to 5.5 this year just because Fannie's buying some bonds
Yeah, this is why it's hard for me to go below 5.75%. It's just
Yep.
like the 10-year yield. You can get there with like the low end of the spreads at 160. That gives you about, 30, 40 basis points from where you are. So you can easily get there with normal spreads. But below that, boy, the 10-year yield getting under 380 is just difficult out there. And I mean, to me, the biggest reason why rates fell last year is because the labor data got weaker. I mean, there was every reason you could possibly have for rates to go up or stay up. Inflation was rising. There was a lot of treasury supply. Every reason that the labor market got softer throughout the year, the 10-year yield slowly moved lower all year long. But now we have a lot of rate cuts in the system. See, I look at it as like 65 to 75% of where the 10-year yield can range within a cycle is still Fed policy. So it's much different. Like in 2023, when the spreads got really bad, we had the Silicon Valley banking crisis. The Fed was still hiking rates, and even before that, the spreads were getting better. But you put all those things into the equation, that's not in a conducive environment for the spreads to get better. But now, it's different, right? It's less volatility in the bond market right now, in the mortgage market outside of that one announcement, and that's a good area to be in. We didn't have that in the last few years. Whenever rates get down to 6%, they just shoot right back up, and all housing data just flowed off of that. Sales get weaker with higher rates; they get better. You don't have any real growth or declines; they just kind of flow back and forth. But this is the first year that you got more inventory, price growth is cooling down, buyers can get in the mix, stable and low rates. I mean, considering everything that the housing market has been through, this is like the best backdrop you possibly can have for buyers and sellers in this environment out here.
That's a great way to sum it up. Okay, so that was an outlook on mortgage rates. Let's turn that into an outlook on unit volume, sales volume. In our work at Compass, we've said that I think it's probably about a 5% growth in sales, unit sales, from maybe 4.1, 4.0, 4.1 to 4.2, 4.25, something somewhere in that range. But it's hard for me to see. There's nothing in the data for me that yet says bigger than that. So, what do you see for growth in sales volume for the year 26?
So I took the last few years, and whenever rates get down towards 6%, we get a couple 100,000 home sales. So this is a good example. Last year was really interesting. Last year was one of the most fun years of being an analyst ever. But what happened earlier last year was that the housing market held up a little bit better with rates at 6.7 than it did the year before. So because of that, the thing I kept on saying last year, because the bar is so low that in the month of June all the way to November for the reports in July, or June to October for the reports in July and November, we should show year-over-year growth because the comps are low. Then mortgage rates got below 6.64. When rates get below 6.6, head to 6, that's when the demand curve really gets better. The sales bottoms on the monthly prints were June. That's about 3.9 million. We've got one more existing home sales report left. If it hits the estimates at 4.23, that's a couple 100,000 homes, like it always does in the past few years when rates fall. So I've got 237,000 more existing home sales. If rates stay 6.25 and under, you can get that amount just based on the sale curve data we've had before. But if they go lower and stay lower for a longer period, that number can rise. Now, in the past, what's happened with previous housing cycles, we get this lull in demand, but then a recession happens, and then rates go significantly lower for a longer period of time, and sales typically bounce hard. We don't have that here because we don't have a job loss recession. So that is oddly enough, that's the variable that housing doesn't have going for itself, is to get rates to 5.25 or 4.875, where the new home sales market is still at 2019 levels. Like if you did it apples to apples, that's like 1 million more existing home sales. So to me, it's that 6.25 and under. If you go above 6.25 and head back to 6.5 to 6.75, the sales just doesn't have the room to grow as much. So I'm looking at it at that point, and so far most of the year has been below that. If we just get that going for the remainder of the year and still keep the economy intact, you could grow sales. I mean, legitimately have a growth in sales year in 2026.
Yeah. Do you, so, okay. I like, we're on the right track. We have a first few weeks. Rates are on the optimistic side, as you said, like the best conditions, the best backdrop going into the year, Q1. And but if rates go back above 6.5, that starts to mitigate, is what
It
you're.
starts to slow down. Really, as long as rates stay below 6.64, it's okay. But in the past few years, it's rates getting back up to 7 that actually, and above that, that slows the sale. It doesn't crash sales anymore because we're working from very low levels, but the flow of sales start to get negative. I don't have a 7 handle in my mortgage rate forecast this year just because the spreads are better and the labor data. But the counter to my rate story is that the labor data gets better. Job creation, let's hypothetical, 130 and 150,000 per month. Wage growth starts to pick up and accelerate higher, and the unemployment rate falls. Because I'm a labor over inflation guy, that worked last year, but for rates to go up, that's the data line that, can impact the housing market, because then the bond markets will go up and say, hey, listen, there's labor data is better. Where are we going? And then that's just going to cause a huge fight at the Federal Reserve that, boy, that's going to be a show in itself if that occurs. President Trump's very adamant about, I don't want somebody that wants to, not cut rates if the economy is doing better, because his logic is that it'll get stronger. So that's a conflict X variable in 2026. Again, that would require that the labor data gets noticeably better, unemployment rate falls, wage growth stops declining and rises, because the Fed's really adamant about their wage growth model, and that could change some of the things for housing this year.
Let's dive into some of the labor stuff now, the jobs market. So you like to say labor over inflation, and I'm fully aligned with this. So when you say I'm a labor over inflation guy, for our listeners, tell me what you mean by that.
So the 10-year yield over the last few years moves in channels like it does all the time in economic cycles. But what occurs is the bond market typically tries to get ahead of the Federal Reserve's changing in policy. So when there's a growth scare about the labor market, the 10-year yield falls. 2023, good example. The 10-year yield was at 3.37%, and I'm like bringing out Gandalf the Grey, says, you shall not pass. We should not break below this unless we're going into a recession. So that line held 8 times. Then I created another line at 380 called the Hodor line from Game of Thrones. It said, okay, where Fed policy is at, the labor data needs to break to go underneath here. We broke underneath there a little bit in 2024, but then the job market got back. So wherever inflation is going, it's irrelevant to me. The economic data and labor data matters more how the 10-year yield and bond traders act throughout the last 3 years. So yeah, last year was one of the best cases because you had multiple variables to keep rates elevated. You had somewhat of a hawkish Fed, you had inflation up to 3%, a lot of treasury supply, all this stuff. The 10-year yield slowly just moved lower and lower and lower because the labor data got weaker.
Correct. So the Fed has a dual mandate for jobs and inflation. The bond market looks at both jobs and inflation. And your point is that the jobs, the labor data is really the thing that's driving policy and driving rates. And so we should be more focused on changes in the labor data than worrying about changes in the in inflation.
Yeah, the growth rate of inflation rose all year long. The 10-year yield went lower all year long because the jobs data got weaker. I mean, literally, if it wasn't for the healthcare industry and the social service, 2025 would be a negative employment year.
Yeah. So let's talk about then we've got a couple of things that are really interesting in the jobs data. Right now, we know that, as you pointed out, the 2025 was the worst jobs creation year of the century, right? Yes. And but unemployment is actually pretty low. And that's because we have fewer workers, we have fewer people looking for work. Even though there are fewer jobs, we have fewer people looking. So unemployment is actually pretty low. The number I care about, I've been focused on, is the hiring rate. And the hiring rate right now is companies are hiring at a 3.2% rate right now, which is as low as it is in the worst of the recessions, like the very lowest level of hiring. So if you have a job which we do, we're mostly employed. One of the reasons that people, in my view, aren't buying homes is because we're afraid to move and take a new job or look for a new job. And so the hiring rate is the number I've been focusing on. Does hiring improve in 26 and really give the economy more confidence? Tell me your views. What are you watching in the labor market?
So the reason I was cautious about the labor market going into 2025 is twofold. Number one, manufacturing jobs have been losing jobs since early 2023. And then with elevated rates in 2024, what you never want to see in an economic cycle is construction and manufacturing jobs being lost at the same time. So rates were elevated, housing permits were at recession levels, starts at recession levels, manufacturing jobs were being lost. Those are not things that population growth impacts. That's a restrictive policy out here. Then on top of that, I remember the first trade war tap dance in 2018 and 19. And what happened back then is businesses can't make decisions if they don't know what the rules are, if things are going around. So back then, things kind of slowed down. And we got to remember, we actually went with Godzilla tariffs. Like we literally brought a big old plaque out there. As like, no, I mean, it's not shocking that things slow down after that because you just don't know what's going on. Just like in 2018 and 19, all that uncertainty causes people just to kind of step back. Now you have a backdrop. If you get more clarity like we did in 2019, like when they got rid of the trade war tap dance back then, and the rates fell, the economic data started to improve. This is where Trump has that muscle memory back then that, hey, listen, if I don't go too crazy here and rates go lower, things can improve a little bit. And I'm talking, you have the lowest bar ever for employment to improve just a little bit even. But to me, as long as we don't make the rules like transparent, there's going to be some friction in terms of businesses putting capital in and hiring people out there. Now, rates are low enough, maybe housing permits starts to pick up again. Residential construction worker jobs have a 6-month little small downtrend. Those things aren't really healthy for a labor market that's supposed to be better. So to me, it's like when the word got out that the Supreme Court was going to knock down Trump's tariffs, businesses start to go, okay, maybe we can, go forward with this. So I think if you get clarity with that and rates go lower, you could get a little bit of improvement in the labor data on the hiring side. Then it becomes a fight with the Fed, right? There's where this is where whoever the Fed's chairman is and who are they going to target. I could see Trump targeting someone like Beth Hammack who wants to raise rates really, stuff like that for 2026. Those are the X variables that we don't usually deal with those things each year. So the backdrop can be better for employment if there's more clarity out there. But if there isn't clarity, we've done this before. It didn't work in 2018 until things were decided. And now, they keep moving things back and forth. But rates are lower, energy prices are lower. We'll see how that works out. But I know a lot of people go into the recession camp. We have to think about labor data like this. Like 1.5 to 2 million people lose their jobs every month. That's very normal, right? This is why jobless claims don't go to zero. But when you have economic growth slow down, and investment slow down, and consumption, so that's when you all of a sudden go, okay, profit margins are really getting hit here. We got to lay off people in a bigger fashion. Hirings are very low, but firings are very low as well. And that's how you get these higher dates, as low as it was during the COVID recession, as low as it was in the great financial recession, but the discharge date and the job openings and the jobless claims data are still historically low. If jobless claims head toward 300,000, rates are going to go lower than anybody imagines. Housing demand will pick up more than anybody imagines, but that really does need the labor market to break, right? And we just don't have that data yet in there.
We've not had an increase in jobless claims.
It's been hovering real lows, and even the job openings discharge data is still historically very low out there. And the economy's still growing, right? So as long as growth is there, there's a lot of deficit spending. There's going to be a lot of things thrown at the economy this year for midterms. So it's one of these years that had just a very little bit more unique backdrop with the Fed and midterms and everything, because this is going to be an aggressive push to try to get housing up, keep oil prices low, and say a lot of crazy things that are never going to happen. But it is what it is, you know.
Yeah. Okay. But so to summarize your view on labor, we're talking about because we have things like the policy, fogginess, like what's actually happening, what are the rules, that are the tariffs on or off, are they getting worse, are they off for whatever reason? Because the clarity matters, and we don't have clarity, that it's unlikely that hiring improves. But at the same time, we still have growing economy, and it's unlikely that we're seeing a break negative with greater unemployment or greater layoffs or things like that. So we're
Yeah.
really in a tight bound there.
Yeah, it's a very unique cycle. I mean, usually when you're going into recession, industrial production falls, retail sales falls, the domestic private investment falls. You know, housing starts is falling with the residential construction workers losing their jobs. Especially trade construction workers have been losing their jobs for 6, 7 months now. So it's very unique. Like you really have to be like an economics person to like go over everything because it's such a unique cycle. But we have a lot of deficit spending, and in this year they're just gonna throw everything they can at this to kind of juice this economy up for the midterms, and then that makes a very interesting 20 to multiple fronts. But take one year at a time, take one day at a time, since we've got the show 24 for economics now.
Yeah. Okay. So let's get back to talking about some of the specific forecasts. Let's talk about home prices. Home prices in the last few years, I like to say the last era of the housing market, had home sales very low, but prices kept relentlessly pushing higher. Affordability kept getting worse, even though sales was very low. In my view, we are entering the new era, and this is how we talked about it in the Compass Outlook, is that the new era, it means that sales can finally grow, unit volume can finally grow, but incomes rise faster than prices, so affordability improves. For the first time, we get a flip-flop in that narrative. What's your view on prices? Do you agree with that on prices, or do you see a up or down, or what's your view for how home prices move nationally in 26?
So last year I was one of the lower price growth forecasts just because inventory is rising, rates were elevated early in the year, and the growth rate of going from 4%, especially the second half of 2024, pricing's really firmed up, right? There was going to be some really hard comps there. And we kind of roughly going to go there. But I actually, if the economy gets better and you have another wave of 20, 30% year over year growth in inventory, I have a slight decline, like a very, very 0.62% decline in prices. But that also needs inventory to growth to be exactly the same that we had early in the year, which is not happening. That's for another topic. And also rates have to be elevated. We don't have like really bad pricing data when rates are this low. But I have inventory growing another year. If the labor data gets better, you could have another situation where you're in the market and something like that occurs, and pricing down just a little bit out there. And then the counter to that is a tug of war. If inventory is not growing like it did last year, which looks to be the case, and rates are 6.25 and lower, the supply and demand can keep pricing just firm just a little bit. So it's really it's a flat basis year. But the one variable that matters more is the inventory growth is here, right?
Okay.
That's the difference. Like 2023 was not a good year. It was pricing firmed up, but we were so low in inventory that even those first few months of sales growing really delayed inventory growth until the second half of the year, and prices were still up 6%. But every year price growth is cooling down, and now we have this tug of war, right? 2 years of slower price growth, wages outpacing, but we have lower rates, higher inventory. It's a buyer-seller's market. This is why I'm very excited about 2026. It's a lot of fun this year to see how this market is going to work itself out.
Yeah, I'm geeking out right now too. In January, I love the end of January data. Like, how steep are the
It
inflection
is,
points?
it is change. I mean, really, since mid-June, the housing dynamic shifted.
Yeah.
And then I always tell people like, because we have the Altos data, people won't realize this till 6 months later. And we kept that theme going though. Every time Sarah and I were talking about 6 months later, by the end of the year. And I think what happened, this is my personal belief, Redfin confused everyone because of that seller buyer inventory chart that everyone started to share. And then the high cancellation rates and delistings, people thought sales were declining and prices would decline in the second half. And that wasn't the case. The market actually shifted mid-June, and that was the low end of sales. And we got 9-month high, 3-month high in pending home sales. All these things got actually better with all those headlines. But inventory growth has slowed. I mean, we went from 33% down to 9.99%, and rates are lower now. Ooh, that's a whole different ballgame, right? And we're going to have such hard comps going into spring and summer on the year-over-year data that to get 25 to 33% inventory, that's very difficult to ask for unless something happens abnormally. So the last few months of 2025 were really telling if you knew where to look. And already like the first 10, 11 days of January was like, whoa, this is still continuing from last year. It really reminds me a lot of late 2022. Right? You remember we couldn't get the tracker up because, we just joined company and we're like, I got to get this up. It's changing like right here. But I'm really, by the time our economic summit is where you and I are going to be on stage, a lot is going to be known about the housing market. But wow, the last few weeks were like eye-popping for nerdy people that track this stuff.
Yeah, so that's the Housing Wire Housing Economics Summit. It's February 10th in Dallas. Come join us. That'd be great. Logan and I will both be speaking there. So that's inventory data. Let's do some summary on inventory data. So inventory grew last year. In the middle of the year, it was 30% more homes on the market than in 24. And that inventory growth leads to softer pricing, which we're seeing now. What we're seeing now is inventory is up just 10% higher than last year at this time. We at Compass had forecast a 10% growth for the year. So a little bit of continued inventory growth for the year. What do you think we're going to end up with? Does it go lower? Does it go to zero?
If everything stays constant, you are possibly going to have a negative year-over-year print at some point this year, because it reminds me a lot of 2023 where, we really need to keep an eye on that inventory data the first few months because the comps are so hard. There can be an inflection point of lower single digits. And then if rates stay lower, it's going to go negative at some point out there. That's going to drive a lot of doomers crazy. But in this environment, the backdrop, because of what happened last year, sets it up for having some very low single digits and possible negative prints on a year-over-year basis. So we'll see how that works out because 2023 rates went up to 8% in the second half of the year. It would have been a much different story if rates had stayed near 6%, but we don't have that backdrop. We can't get to 8% mortgage rates anymore. The economy has to be booming for something like that. Inventory might, we should see some negative year-over-year print if rates stay lower and the demand curve gets better, just on a comp basis out there.
Yeah. And to summarize the 23 for people who don't remember, 22 was the brakes got hit hard. Rates jumped in the first February, March, and if you hadn't sold your house by June, like there were no buyers and the market tanked the second half of the year. Price reductions were high, inventory was sky, all the things.
Slope of the curve, we always say with the Altos data. If you look at that, boy, the inventory curve really picked up. Like the slope of the curve is normal the last few years. We picked up a little bit more last year, but boy, that was just something magnificent to see. Price cut percentages, inventory growth, demand. It was literally the fastest sales crash in history. Like if you look at 2005, like existing home sales went from 7.2 million, but it took all the way to 2008 to get to kind of like that 4 million level. This happened, like the monthly sales happened all in 1 year, and especially the second half, but that 4 million level held. That's been a big part of my work for so long. Like we just don't have data to really go much lower than 4 million. And then it's just been a tug of war fight between rates and inventory and everything. And that's why 2026 is exciting because there's so many things that are different now than the past few years. And we get to see what the market really shows out there.
Yeah, that's the beginning of 23 was surprising. We watched, rates dip to about 6%, and we watched surprising demand improvement. We saw inventory tighten after a big spike. We saw price reductions drop really quickly. The price reductions number is the one that I'm watching very closely in January here and February. Is how quickly do those drop this spring? Because that's a real fast indicator of demand.
This is why everyone needs to track weekly data. Like forecasts in itself, or so, like the older I get, I realize how useless a forecast is unless you have a model to go with it, because things can change and you don't want to wait 6 months, right?
Yeah.
You don't want 6 to 12. What happened, right? Because it's a few weeks and then the trend goes and it gets there. It's just people tend to wait too long to see something. Like we're always going to be 2 to 3 months ahead of existing home sales report per minute. We're always going to be 3 to 6 months ahead of Case-Shiller. But to watch it live with a 10-year yield, like I am so geeked out happy. Like this is like a lot. This is fun. Like last year was a lot of fun for me, and this year looks like to be a lot of fun. X the crazy headlines, but yeah, we get to see how it works with a more balanced marketplace.
That's great. Okay, so let's do a fun topic, which is what are the chances and what would have to happen to have a major price correction that the doomers have been asking for forever, but what would have to play out to have prices drop 10%, 5 or 10% nationally in 2026? What's got to go wrong?
So a few things. The major doomers are always wrong because they're always 18 months like way too late. Like you need to see housing data like deteriorate really before to go into a year out there, because it's really rare for nominal home prices to fall historically post World War II. But to have like a big crash, you need a few things. Number one, the new listings data has to take off. It has to go vertical. I've always highlighted, like your story with Goldman Sachs and Lehman and how the new listings data looked back then. Because when you see stress in new listings data, those are sellers that are not normal in the normal curve of that data line. Like 80 to 100,000 is normal during the seasonal peaks. You get something in the 150s or 220, something like that, where all of a sudden something is forcing people to go out there and sell. And that price cut percentage needs to increase with those new listings, and there has to be the inventory growth with it. Because what you don't have now, you don't have distressed sellers. Like you don't have that whole process. Minimum takes 9 to 18 months. So it can't be a 2026 story. Like distressed sales as a big, that's something that 2027, 2028, something like that. So it has to be, something that happens the second half of 2022, right? Where inventory just speeds up higher, demand crashes down. Whoever is in the marketplace has to work off of, okay, we are seeing a decline in demand. We're seeing an increase in new listings, and we're increasing inventory. There's too much supply. I have to sell my house regardless. You have a lot of those kind of sellers, equity sellers who need to just move. They bring the prices down, which is different than distressed sellers. Something like that would have to occur in 2026 to get, 10 or 11%, which is really rare. Like only time we ever had that post World War II was 2008. And there were inventory was like 4 million, monthly supply was at 10 months. We had major distressed sellers in there, or there's already underwater mortgages. The credit market was breaking and the recession hit. None of that is here at all. You need what I call equity sellers. You need to have a lot of inventory come in a very short amount of time, and you have to have people say, I've got enough equity, I'm okay. Something like that with duration would be a 2026 thing, because you're not getting the 2008 model. So you have to create something that these people have to sell, they don't delist, and demand is just simply not there with the supply coming on the market. So new listings, active price cuts, because it's hard to get sales to really crash from these levels. So it has to be a supply story and an equity supply story out there.
Great. Okay, so that's always a good thought experiment, and there are lots of buyers out there who are potential buyers who are saying, I'm just going to wait until the crash happens. And, so watching your take, and I like this too, which is if that's going to happen, we need to see new listings start climbing each week. And as of right now, there's no sign of it. There's no
Nope.
sign of it.
There has been no sign of it since 2013. That has been one of the more stable data lines, and the last 3 years have been the lowest. The Airbnb crash, all these people are going to sell their equity because they're broke and everything. None of it has been there. If it's there, you and I will tell the whole country it's coming, but it hasn't been there for years. But we have all these speculative theories from people who have never tracked housing data in their life, so you can clearly see this. And then you work off of that. But that has to come into the data pool before you engage that conversation.
Great. Let's switch the topic now. There is another bit of news, and we've touched on it a little bit, but there's a lot going on with the GSEs, with Fannie and Freddie, with things like the IPO, with them suddenly buying mortgage-backed securities, with, Trump using them as an instrument of policy. Tell me what I should be thinking about the GSEs in 2026. What's top of mind, and what are the big influences here?
So if it was up to me, I would never take him out of conservatorship. That's been my line for over a decade. I mean, they have been perfectly functionally, normally fine, but things have changed recently. Now, because of the cap rules, there's limits to how much they can buy out there. I don't know if they're going the IPO route now because of the midterms. And I don't know if their bankers said, if you're going to use this money for mortgage-backed securities, then, Sarah and I talked about this once last year. We said, if they really wanted to, they can buy mortgage-backed securities if they want. But I don't know if the IPO process is preventing them. I mean, they could do pricing changes. There's a lot of things in conservatorship that it appears that Trump wants to get the midterms going that they can do to help. And they're doing half of the things right now out there. So I'm not sure about the IPO process anymore as long as this goes on. I know there's a lot of ideas, do you add prepaid penalties on there to help the spreads or stuff like that? But for right now, the government is going to do what it can to juice up housing this year, and then they'll market it like crazy going into the midterm. So expect stuff over the next few weeks. But the GSEs, to me, I don't know if the IPO is there. There's limits on how much they could buy. But the spread story, a lot of the good news is already in there. Right? There's only so much that can go lower than, if it goes under 160, that was not at all in any of my mindset whatsoever. So that power is somewhat limited unless they come out and go, oh, we're reducing pricing as well. Right? That's the one other card they can
Loan pricing,
have.
fees.
The LLPA's prices, they can do that. So that's another card that could be used. And we'll see what happens in the next few days about, what will be announced out there. So that's my view of the GSEs in this regard.
Got it. Well, we know that Bill Pulte listens to Logan. So, when you suggested that, hey, the GSEs could be buying loans, I'm going to assume that that's when they started buying the loans. So they were listening to Logan's presentation.
Well, the thing is that they used to be bigger buyers. I mean, that was normal for them. Under conservatorship, it's just different. It's funny to me because the concept of mortgage-backed securities, things like people think that that's the only reason rates were lower. It's really Fed policy. You can't get rates really down toward 5% or lower than that unless you have zero interest rate policy. And the Federal Reserve is not going to do QE or anything unless you have zero interest rate policy. So there's limits. There's literal limits to how much lower rates can go.
Yeah.
If you get a new Federal Reserve member, new governors, that's a whole different subject. But the GSEs kind of done most of what they can, but they still have one more card left if they want to help pricing. But a lot of that is already priced into the market rate. This is why it's really hard for me to go below 5.75 unless other variables kick in.
Yeah, and I see you had a point about not letting them exit conservatorship. And you said, and that was your view because you see them as instruments of policy to help the market. Is that right? Is that why you said you?
It's stable.
Yeah.
And because it's stable, you don't have to worry about a bank's stock price going lower, or you can you can do things under conservatorship that you can't do as a publicly traded company. And because of that, one of the unsung heroes was the GSEs in conservatorship during COVID. Credit flowed, rates stayed low, they did forbearance. Oh my, I mean, the trifecta, right? Yeah. Once you make them publicly traded companies, things change. Yeah. Now, of course, there is the notion about is the government going to guarantee the mortgages? If the government doesn't back up the mortgage market, then pricing goes up, right? So regardless of what the final outcome is, I don't think they want to take that risk, because I'm pretty sure they're talking to bankers and investors and going, hey, listen, what can we get away with without rates going up? Besant said that, we don't want to do this if we think rates are going to go higher. And now it's midterms. So you can't really mess this up. So whatever they're doing now, or whatever they're thinking of doing now, this is not the time where you want to roll the dice, right? Yeah. So 2027 is a whole different conversation. But for right now, I'm assuming they're talking to enough people, and I don't know if the IPO will happen, but they have limits on how much they can buy, and maybe they find a way to increase it. I don't know, but it's interesting that they went that avenue first, and they have other cards to pull if they need to.
Yeah, and my take on that is that initially Trump looked at those as like a deal that he could do as an IPO. Now he's realized that he can use them as an instrument of market. He can put his thumb on the scales like he likes to do. And now he's not going to IPO them because they are his. He's finding them useful. Yeah. He's not interested in handing them off. And ironically, that's better for the country in the long term, because we're not doing things like, creating potentially more volatile situation out there. Or
I think in one of our podcasts last year, I told Sarah, I said, just remember the movie Ghostbusters, where Bill Murray tells the mayor, Lenny, think of the voters. If you save this city, think of all those voters that will remind, So it's midterms. Like, I hate politics. It's not my thing. But as an analyst, you have to okay, what can they do? And they went hey, listen, the government's got to come in and help. But in regards with the spreads were already getting better. They would have got a little bit better. So there are maybe other levers that they can pull out to things get better. We will cross that bridge if they ever announce them. But it is very interesting how it looks like to me there was polling done by Republicans for Republican voters, and affordability was just a way too big of an issue. So they're going all out, for this year, and we'll see how that works out.
Great. Let's talk about one more data point that you cite a lot, and that is the MBA's Purchase Mortgage Applications Index. That's a number that's been up pretty big all year long, or most of the year, like 20% more mortgage applications. These are applications to buy a house. These are not refis. They're purchase mortgage applications. They're up like 20%, but sales are up 2%. What's going on there?
It is one of the more confusing data lines that I've seen for the last 15 years. Purchase application data is a trend survey. It's the MBA basically sends out to their mortgage brokers, bankers, and they come back. What typically happens is in 2024, our forward-looking data, our pending sales got better, but the purchase application data week to week was improving. You need about 12 to 14 weeks of positive week-to-week growth to get something in that data line. But in 2024, the data was still negative year over year. So it confused people that people thought sales were declining in the second half of 2020. No, they were getting better. Same thing happened in late 2022. We had 12 weeks of positive week-to-week data, but we still had negative year-over-year prints. It gave us like 500,000 home sales in 1 month. That was very abnormally high. But last year, we're working from the lowest levels really in history. If new listings data grows, most sellers are home buyers. They have to fill out an application. That can explain the year-over-year data growth. But we really didn't get any traction on the week-to-week until mortgage rates got below 6.64. And then that was kind of the second half of 2025. And then with more positive week to week data than we saw in the early part of the year. Early part of the year wasn't really negative on a week to week, but it wasn't really growing. It was in a sense flat. That has given home sales, 9-month high, and then pending home sales grew, and the NAR's pending sales data grew. So the week to week data has to be accumulated for at least 12 to 14 weeks, let's say out of 18 and 19 weeks. You need about 12 to 14, and you go with that because the year over year data negative and the year over year data positive didn't give you the best take of that data line. And I've seen this happen a lot over the years. And this data line got completely screwed up with COVID. It's just the pre-COVID markets were second week of January to the first week of May. And then after May, total volumes would always fall. And it would be such a normal slope. It'd be like all the housing data, and all hell just broke loose after COVID. And it looks like the seasonal increases happen now in November and December instead of, kind of January or February. So always keep an eye on the week to week data. And if you string out a 20-week period and you get more than 12 weeks of those positive, sales will grow. And that's how the sales levels for the existing home sales grew the last few years, is when the week-to-week data looks better, no matter what, though the year-over-year data, whether it was positive or negative, the week-to-week data was a better accuracy with that data line than the year-over-year.
So you're looking at the slope of that line rather than the absolute level.
Yes. And last year was just one of those years where it was so low. New listings data at least got to the bottom end of the normal range. You had more sellers. Those sellers fill out an application. Most of them do. So because of that, because of the low bar, the base level was so low, anything was going to make that percentage increase rise. So that's why I've kind of said, take that growth with context, focus on the week to week. And now that we had, almost 12 weeks of positive week to week data, sales are growing. We're going to get 250 to 300,000 more home sales than from the lows in June. And that's what it is. It is a very, very confusing data line. It confused people in 2024 because sales were rising when the thing was negative, and we didn't see the sales growth that the purchase application data was showing, 25% year over year growth. People thought, okay, here we go. But it's always been a tricky survey because of that.
Yeah. So I like that to think about it as the slope of that line rather than the absolute level. In fact, the price reductions data that I like to watch, is also, the slope is really useful. Like how quickly are things dropping?
Slope of the curve is everything, man. I'm going to get more shirts and T-shirts and hats.
Yeah. Slope of the curve.
That's everything in economics, and that's why I love the tracker data, because that slope tells you everything.
You want the second derivative? Okay. All right. So when we wrap up for 2026, we're already put in a whole hour here, man. It goes super fast. Give me a couple of big takeaways for 26, things to watch, things that you're excited about to pay attention to.
So if the rate story stays lower for longer, make sure to read the first few months of the year. Because if the first few months of the year look similar to 2023, everyone has to adjust, right? And that's part of tracking live data, is being able to adjust to what the marketplace did. And my talking points was that the market shifted in mid-June. That is still continuing. So adjust to see, does this lower rate environment and this more stability create a better atmosphere for the housing market early on? And if it does early on, go with it. Just go with the data until it changes, but don't sit there and not just ignore it and be like these people that are 6 to 9 months or way too late on that. That's my theme in 2026 because of what we've seen earlier, because rates are down here and the midterms and everything. It's a very, very dynamic first few months of the year. And because it's going to be you can't get rates back up to 8%. It's going to be really difficult to get rates past 7%. Go with what the lower rate market is telling you, not what you fundamentally in your ideological views are. And those first 3 months are key. Just even the next few weeks are going to be key out there as well.
So, all right. So if the data is strong, it's strong.
Go with it, man. Just go with it. Don't, whatever. A lot of people assume X has to happen, and just because of what they believe in, and go with it. And always remember, the labor data is key. If the labor data is softer, that's in a sense beneficial for housing. And don't fall into this this trap that a lot of people do that, well, we're going into recession. Who are going to buy the homes? We have 162 million people working. Existing home sales are at 4 million. I always make this joke. My army's bigger than yours. Like in COVID, right? You know, people are saying, Logan, there's 20 to 30 million people unemployed. Who are going to buy the homes? I say, there's 5 million in forbearance too. 35 million people off the grid. They're like, who are going to buy? Well, my army's still bigger than yours. I got 133 million people still working. Affordability is good. 3% mortgage. As soon as they stop hoarding toilet paper, right? Game on. It was the sharpest housing recovery in the history of the world. So if a recession happens, go look at the history of housing data during recessions. When you're working from very low levels of sales, it doesn't take much to move the needle, and you still have majority of the workforce employed.
That's right. Well, it is indeed like that moment, those 3 weeks of downturn in COVID, the 3-week housing market recession in COVID. It's like the funnest time to be in our business is when you get to be contrarian and bullish.
Yes.
When you get to say the data is positive when all the headlines are still very bearish, contrarian and bullish.
One of the most fun times I've ever had is when we wrote that COVID-19 recovery model April 7th. I was the crazy lunatic, for the next 3 months. And I was like, game's on. It's already over. It was so much fun to drag everyone throughout that whole recovery. And I'm kind of thinking, can this be a mini version of that? We'll see in the next few weeks. But again, it's so much healthier now than what it was in 2020, 2021. There were just so few homes available for sale. It was forced bidding onto properties. That's never a good thing for the housing market. So I'm happy. Like 2025, I was very happy with how the housing market, because it got balanced. And now we have a tug of war between buyers and sellers and low rates and more inventory. So this is the best you could hope for in this environment, considering how unhealthy that market was with active inventory.
Logan Mohtashami, thank you so much for taking the time with us today. We'll see you on stage at the Housing Wire Economic Summit in a few weeks in February 10. I'm sure tickets are still available for that, but actually they're going pretty quick. So that'll be a great one. There's some big names on that stage, including me and Logan.
Yes.
So thanks so much, my friend. We will talk to you again soon. We'll see you in person very soon. The Real Estate Conversations podcast is brought to you by Academy, the go-to source for real estate agent education and on-demand learning. All agents have access to Academy's extensive library of content, video, and technology for building a high-performance real estate business. Academy is also one of the reasons that our agents are the most productive in the industry. Learn more at the Academy link in the episode guide.